Friends, in this video for ithought Advisor, I am talking to you on the topic what I really like about creating products. Being an advisor is an open-ended thing. You are free to do many things, adapting to the context of the market, adapting to opportunity, and you make choices according to the moment. But that's not the case with creating products. A product has to be compliant to a set of rules. So, right from the time you frame these rules, you must be aligned to what you expect from the product. So, the beginning is, who is this product meant for? Usually, the products which suit the average investor, the person who is saving to create a retirement corpus or to create a wealth corpus. That individual is not going to have the same risk appetite that I have. I really like creating a product for somebody who will be able to invest consistently and over a long period of time to achieve his end goals. So, the rules have to be aligned to who we are creating the product for. After deciding who we are going to create this product for and then setting the basic rules, then you identify how the product will be managed, which is you identify the ideal process. When I say process, it is about how you will build a portfolio, how that portfolio will be built in bull markets, how it will be built in bear markets, how the portfolio will be maintained between bear markets and bull markets, how you will book profits, under what circumstances you will take a cash call, when you choose to be fully invested. All these factors will have to go into the process. Ideally, the rules should tell you how you will apply these in the process. Then you decide what is the fee that you must be paid as a product manager. You decide how that fee must be aligned with the interest of the investor, because if you really want a product to succeed, the fee should be ideally aligned to the investor's interest, and it should work for the investor both in good markets and in bad markets. So, it should not be that you are able to charge a very high fee in a bull market and you still get a basic fee in a bear market, which means the client pays you in good times. He pays you more, in fact, in good times, and he also has to pay you in bad times. So, the product fee structure should be curated where the client feels that he is paying a reasonable fee at all times. So, that is a very, very important part of product curation. Then we decide how you position the product, because a product can be curated for a very large audience, but you may end up positioning it for a very narrow audience. It's important that the product is not only created for a very large audience, it is also positioned correctly so that a very large number of people identify with this product and say, okay, this product suits me. For example, Solitaire is a product which I curated thinking of those who like to invest across categories, those who prefer a multi-cap or a flexi-cap approach. That was the audience, which is a very, very large Indian audience, and we wanted to consciously curate a product which will suit them, because we believed that they were not getting the best experience in the mutual funds, and it is possible to curate a better investor experience through a product. Similarly, when we curated coin, the idea was the index investor must also be given an option to invest only in the best part of the index, and he must also be given the choice to pay fees only if he gets performance. Usually, you are told that index funds must be priced cheap, and that's the best way to help the investor invest a lot of money in it. We thought, let's take the bar higher and say that any fee must be paid only if the investor gets a basic return. So while we curated coin, we were particular that the universe of stocks must be restricted and we need not own all the stocks in an index, and we were also particular that the client must get a basic return and pay fees only on the returns above that basic return with watermarking. So it meant that somebody who has more than 50 lakhs to invest need not go to an index fund, but they could buy coin and get a much better investment experience. Now, this meant that we would get a much larger audience of investors who want to invest in equity as an asset class, who don't want to blindly pay fees, and who want the manager to be held accountable for returns, and who also don't want to take very high risks. So, I gave you two examples of two very different products, but both products would address a very large audience in a way which mutual funds don't address, in a way in which the traditional PMS products don't address. You would have noticed that in both these products, we don't talk about trying to get the highest returns, but taking moderate risks and being accountable to get returns better than our risk profile would otherwise help us generate. So, the risks would be moderate and the returns would be more than commensurate to the risks taken. That's the core of our product design and how we curate products, and that's precisely why I enjoy product design and creating products, and that's something which always gives me a satisfaction, and it also teaches me a lot about what suits so many investors. What is it that a very large audience needs and how can we meet their expectations? So that is something that gives a lot of learning and a lot of satisfaction. Thank you for watching this video.